In this video, we're going to be using a problem to demonstrate the allowance method for uncollectible accounts using a balance sheet approach. GAAP requires that we recognize potential bad debt expense in the period in which the sales occurred. And notice I used the word potential. We don't know exactly which accounts are going to go bad, but we know based on our experience that there is a probability that we will not collect the full amount of the invoices that are owed to us. And this is known as the allowance for uncollectible accounts. It is contra to accounts receivable. They are both balance sheet accounts. In this approach, using a balance sheet approach, we're going to be estimating what that allowance is going to be. Any change to the allowance count will affect the bad debt expense we recognize in a period. So let's begin by taking a look at the allowance for uncollectible account activity for this company. We're told the beginning balance was $68,000. During the year, we had write-offs of $46,200. So our balance before the adjustment is our beginning balance less the write-offs. So what does this look like in the journal? Well, we're going to be reducing the balance for uncollectible accounts. It's a contra asset account. Therefore, it is reduced through a debit. So now we will choose the allowance for uncollectible accounts. Notice we do not choose bad debt expense when we can identify a specific account. We're going to recognize that bad debt expense based on the revenue recognition, not the actual account going bad. So our debit's going to be to an allowance on uncollectible accounts. The credit will reduce down a specific customer account. That, in effect, will reduce down the accounts receivable balance. Accounts receivable balance is made up of the balances of all of our customer accounts. If we reduce a particular customer account, that's going to reduce down the overall accounts receivable. So we're going to be reducing the allowance by $46,200 and reducing individual customer accounts by a total of $46,200. Now our required balance is going to be 3% of the ending accounts receivable balance. The total of our accounts receivable balance, according to the problem, is $2,223,000, and we're going to apply a estimated percentage of 3%. So our bad debt expense for the period is going to be the difference between what our allowance account needs to be minus the balance before we made our adjusting entry. So we're going to have to increase the allowance for doubtful accounts by $44,890. We're going to do that through a credit to the allowance for doubtful accounts based on our analysis. And that increase in the allowance will cause us to recognize bad debt expense of an equal amount. What are we going to be reporting on the balance sheet? Well, we're going to report the balance of accounts receivable gross, $2,223,000, less, well, we're not going to use bad debt, we're not going to use the write-off. Instead, we're going to reduce the gross balance by the allowance for doubtful accounts. That is not just the amount that we recognize for the period, but the full contra balance which after our adjustment is going to be equal to the required amount of 66,690, and that will give us a net realizable value on our accounts receivable that is equal to 2,156,310.